Good morning and good afternoon. My name is Sebastian Lebda. I am a transfer pricing director with PwC Poland. And today I would like to welcome you to our webinar, which will be devoted to new transfer pricing regulations. I will run this webinar today with my colleague Piotr Niewiadomski.
Good afternoon.
Who is a manager in our transfer pricing team. Maybe a few words why we talk about new transfer pricing regulations. As you might have heard, pretty recently the Polish Parliament has approved a new transfer pricing regulations, and now we are waiting for the signature of the President. Once the President will sign the new regulations, they will become effective, and they will be binding for taxpayers going forward. Now, maybe a few words of the background. Why we have these new rules in place? When you think about these new regulations, they are not really a result of purely local initiative of the local Ministry of Finance. In reality, the new law is a result of works which were run within the OECD. Over the last 2 years, OECD was working on the project Business Erosion and Profit Shifting, and within this project, one of the items which was worked out within the OECD was effectively a modified Chapter 5, chapter which talks about transfer pricing documentation requirements, and the Polish Ministry of Finance, who was represented in the OECD, has taken into account the recommendations worked out by the OECD and has decided to prepare a draft law which currently has been already approved by the Parliament. So we are really in a situation when the Polish law is really following the OECD recommendations, and today during our webinar we would like to talk about basically few points. If you look at the agenda of our webinar, you will see that we will start with the scope of the documentation. We will talk about the time frames. Then we will move to the local file thresholds. We will talk about the difference between the currently existing documentation requirements and the new ones. And then we will move to the new requirements, basically, which include taxpayer statement, CIT TT form, master file, which probably to many of you is can be a document which is known, especially in other countries, but not formally commonly prepared in Poland so far. Then we will move to country-by-country reporting form, and at the end we will summarize it for you and provide you with our recommendations. So now I propose that we move to the first point of our agenda, scope of the documentation, and Piotr will introduce the scope and we'll talk about in more detail now.
So hello again. I have the pleasure to start discussing the scope of TP documentation in Poland. So just to set the scene and start with giving you a general overview of what will be required according to the new Polish requirements. You can see now in the slide that there are 5 main elements of the local Polish TP documentation under the new regulations. The first one is local file. The second is taxpayer statement. We'll in a moment give you a few more details on that, because especially to those of you who are from abroad, this might be a completely new item. Then we will move to item number 3. This is CIT TT form. This is something which resembles CIT return, CIT declaration that must be submitted after the end of financial year. Then we have item number 4, which is master file, commonly used within multinational enterprises, and number 5, country-by-country reporting form. which is also more international, so to say. So we start we start talking about TP documentation requirements in Poland in the case of taxpayers who have revenue or costs in a given year exceeding 2 million euro. This is important that we look at total amount of revenue and total amount of cost, because we very often are asked whether we should take into account, for example, only operating revenue or only, for example, revenue achieved in transactions with related parties. The answer is no. We look at total revenue or total costs achieved or generated by a given taxpayer in a given year. So if a company exceeds this threshold, it is obliged to prepare local TP documentation. This is the threshold which applies to the company, to the taxpayer. There are also materiality thresholds referring to specific transactions, and we will explain them in a moment. If a taxpayer is obliged to prepare local TP documentation, then automatically it is also obliged to prepare item 2, taxpayer statement. So these two go together. After exceeding the next threshold, which is 10 million euro, the scope of transfer pricing obligations increase. So first of all, the taxpayer will be obliged to prepare CIT TP declaration, and at the same time, the local TP documentation will need to be extended and will need to cover a benchmarking study. So this 10 million euro threshold is also an important one. Then after a taxpayer exceeds 20 million euro threshold, it is of course obliged to prepare master file describing transactions conducted within the group. And what is also important in this case, in the case of a master file, we take into account standalone revenue or costs achieved by a given entity. So we do not take into account aggregated or consolidated revenue achieved, for example, in Poland, but only on standalone financial data. And then the largest entities operating in Poland, the largest capital groups, whose revenue exceeds 750 million euro, will need to prepare country-by-country reporting template. In this case, we take into account consolidated revenue, and I guess this is something which is more or less similar across all the OECD countries. So if you are interested in transfer pricing matters, you have perhaps heard about this one very well. Poland implemented OECD recommendations to very much to a great extent. So this one is quite similar to what the OECD recommended. You can also see in the right that we have some separate rules dealing with tax havens and joint venture agreements. Irrespective of the revenue or costs generated by a given entity, if a taxpayer concludes such transactions like setting up a joint venture or a company with an entity located in a tax haven, or conducts any related party transactions with these entities located in tax havens, and the value of these transactions exceeds very low thresholds, 20,000 euro in the case of transactions, or 50,000 euro in the case of share capital of joint ventures or companies where shareholders are also located in tax havens. Then after exceeding these thresholds, TP documentation must also be prepared. So this is in general what we will talk about today and what are the materiality thresholds. Now we can move to time frames, because the most important question perhaps that any one of you asks for yourself is, okay, the new TP regulations will come into force, but when will I be obliged to do anything? Some of you may also think that if, as you can see now in the slide, most of the local TP regulations come into force as of 1st January 2017, there is still some time to prepare for the new regulations. But this may not necessarily be true. As you can see, we started presenting the timeframes on this slide with country-by-country reporting form, because regulations concerning this report, this form, will come into force as of 1st January 2016. So if a multinational group, multinational enterprise operating in Poland exceed the threshold and satisfies other requirements which we will discuss in detail in a while, then it will need to gather financial data and report these numbers to the tax authorities just in a few months. So it is now the right time to prepare for the new regulations, to do a quick review of intra-group transactions, verify maybe whether we, for example, are prepared to gather this information, whether we have designed efficient processes that will enable us to get the right information, and whether the CBC reporting form indicates maybe something that we are not very comfortable with. So we can now think whether we are ready to report all these data. Then if you look at the next item, local file, it indeed comes into force, the new regulations indeed come into force as of 1st January 2007, so there is still some time to prepare. But as Sebastian will mention in a while, one of the points that will need to be covered according to the new regulations is description of restructurings conducted by the group. And even if the TP documentation, which will be for the first time prepared under the new regulations, will deal with 2017 financial year, it will need to describe restructurings conducted in 2016. So you need to be prepared to gather necessary information effectively since 2016 starts. And similarly, as in the case of country-by-country reporting form, we recommend to have a look at intra-group operations and once more verify whether they are all at arm's length and whether we are comfortable with reporting many details about these transactions. Then when you look at the right, you see that at the beginning of 2017 there is again an urgent need for action for a given company. This is because all the elements of TP documentation will need to be ready for at the latest at the end of March 2018 if an entity has a financial year equal to the calendar year. Of course, this is the assumption that we made here. So in such case, the company will be obliged to submit CIT return at the end of March, and at the same time it will need to declare to the tax authorities that the complete TP documentation was prepared. So the Polish taxpayers will not be obliged to submit the full documentation to the tax authorities, but they will only need to be obliged to submit a statement that we declare that complete TP documentation has already been prepared. And this is of course regulated not only by the corporate income tax law, but fiscal penal code as well. So there is no way that TP documentation is not prepared at that moment. So there will not be much time after closing the financial year 2017 to prepare local TP documentation as well as other elements like master file or other items. So we recommend starting the process a bit earlier, doing a review of intra-group transactions upfront, even before the tax year starts, and start gathering necessary information within the tax year. The same timeline applies to the master file, as you can see on the slide. The only exception is that the group operating in Poland, which will be obliged to prepare master file, is in a position to indicate an entity which will be preparing this master file. And actually, the deadline for preparing master file can be to some extent prolonged, or let's say moved in time, depending on in what country the entity preparing master file is operating, and what is its tax year, and when it is obliged to prepare its own tax declaration. So these are the factors that may impact the actual deadline for master file. But as a rule, it is in line with what we see for local file. And now at the end we see the remaining two items. This is taxpayer statement and CIT TT declaration. They not only need to be prepared by the end of March 2018, but they also need to be submitted to the tax authorities. And these are also very sensitive documents, especially CIT TP form, which Sebastian will elaborate about in a while. So we recommend preparing also this form sometime earlier, just to be sure that we prepare accurate data which are consistent with what we also disclose in other items of TP documentation. So I hope this is all clear for you, and we can now move to the next section. As I mentioned before, we start thinking about transfer pricing documentation and obligations that may be imposed on local taxpayers in Poland after a given taxpayer exceeds the level of 2 million revenue or costs. But I also mentioned that there are transactional materiality thresholds, which I'm going to describe in a which I'm going to describe now. And here on this slide, you can see that there are different levels of materiality thresholds applicable for related party transactions, depending on the scale of operation of a given taxpayer. So if, for example, there is an entity which is a relatively small one, and it achieves 2 million euro revenue per year, you can see that its materiality threshold is 50,000 euro per year. So it should prepare TP documentation for every transaction which exceeds 50,000 euro in this given year. If we talk about the largest taxpayers whose revenue exceeds, for example, 100 million euros, then this materiality threshold goes up significantly, and it is 500,000 euro per transaction. So here we can see one of the positive changes that will take place once the new TP regulations come into force. In the case of the largest taxpayers, and in those middle-sized ones, it is also right. Let's say the less material transactions will not need to be documented. So we will discuss in a while how the new TP regulations will extend the scope of the local TP documentation, but at least some of the taxpayers will need to report less transactions, because some of them may not exceed the materiality thresholds. You can also see in this slide that there are also some exceptions. In the case of tax havens and joint venture agreements, the thresholds are 20,000 euro and 50,000 euro, irrespective of the scale of operations of a given taxpayer. But these are specific thresholds. So I guess those of you who will conduct such transactions can always ask us a direct question to discuss whether such transaction should be documented or not. There is also one very important change in the new regulations concerning the scope of TP documentation. As you can see in the gray box, if the tax authorities conclude that there are transactions which do not exceed the transactional materiality threshold as presented here on this slide, but anyway, the tax authorities would like to scrutinize these transactions, would like to get into more details, they can request that the taxpayer prepares such documentation. And in this case, the taxpayer has a deadline of 30 days to provide such documentation. Perhaps many of you are aware that currently the deadline for submission of the TP documentation upon the request of the tax authorities is only 7 days. So fortunately, it won't be the case that anyone will need to prepare such documentation within 7 days. But the assumption is that every taxpayer prepares the TP documentation at the end of March at the latest, as I mentioned before, and prepares the, let's say, additionally requested TP documentation within 30 days upon this request. And then, assuming that all this documentation is already prepared, you still have only 7 days to submit this documentation to the tax authorities when they request it. But in this case, it will only be a technical thing to do. You will just need to send it. So no need to prepare TP documentation within 7 days. It will need to be prepared upfront. Now, we would like to ask you a question. This is a question, let's say, a survey based on which we would like to check what is the expected expected number of transactions that you think your entities or your Polish subsidiaries will need to document according to these new regulations. And this question actually actually also the aim of this question is to verify whether we are right that the new regulations will reduce the number of transactions that need to be documented. You can answer the question right now. You should see the answers. And in many cases, our clients beforehand reported that they are very often obliged to prepare around 20. Almost in every case, they needed to prepare above 10 transactions per year. In many cases, it was even more than 20 transactions per year. And we assume that although the scope of transactions of the TP documentation will extend, the number of transactions covered will reduce. So we are now waiting for your answers. I can also remind some of you that there is a chat going on. Agata Biernat, our TP specialist, is answering your questions. So if you have any specific questions about issues which we do not cover within our presentation, you can always ask them on the chat. So we are now still waiting on your answers, and we have the answers now. And actually, as I expected, the number of transactions that you expect will need to be covered by the TP documentation according to the new requirements will reduce. So many of you answered that only less than 5 transactions or between 6 and 10 transactions will need to be documented. But still, there is a large group of you who thinks that even more than 20 transactions will need to be documented. So this I hope was an interesting question for you. And now I would like to pass on to Sebastian to discuss the requirements of the local TP documentation.
Okay, so let's move to the content of the documentation. As Piotr mentioned, one of the first documents that taxpayers will have to prepare is a local file. For many of you, this is nothing unique. I mean, local file was always prepared by the taxpayers so far under the existing regime. However, as you may see on the slide, the new regulations will effectively extend the scope of the documentation that will need to be prepared for the under the local file for all the transactions. So you see on the right side you have a column where you have all the items that are required under the new regulations. And then next to that, you have the current regulations, where you see that we have significantly less items to be provided under the currently existing rules. Now, I'm not going to talk about the existing rules, but I would like to focus on the few items that I believe are critical when you think about the local file. First thing that is probably not common to somebody who is not living in Poland but abroad is maybe a kind of a surprise that benchmarking study is something new that will be provided under new regulations. But so far what we had in our local law, we had a limited requirements in terms of documentation, which did not force the taxpayers to prepare a benchmarking studies. Quite often the documentation was prepared in a narrative form. It included functional analysis, description of transactions, and the method applied in a given transaction. But quite often there was a limited information on real numbers, on the profitability achieved by the taxpayer, and any benchmarking studies. Some taxpayers included the benchmarking studies. Obviously it was always recommended, but now the key difference is it will be formally required. And the benchmarking studies will have to be prepared in situations, as Piotr mentioned, when the taxpayers exceed a 10 million euro threshold annually in terms of revenues and costs. Now, additional new feature which is connected with the benchmarking studies is that they need, where possible, they need to be prepared on the local comparables. So I know that in many situations it was quite common so far to prepare the benchmarking studies which were based on the Central Eastern European comparables or European comparables. But the expectation now is that at least in the first step there is a careful process made and an assessment made to what extent the local comparables are not available and are not sufficient. So that's one key difference. The second key difference to me is a need to provide a financial information. As mentioned, so far taxpayers quite often provided only a value of the transaction, and many documentation did not include any real numbers. Now it is required that the financial data provided will be aligned with the financial statements. This means to me that you should start with the financial statement and, if possible, do the segmentation of the profit and loss and calculate the actual profitability earned on different types of transactions which generate revenue for the taxpayer, obviously, not for the costs. Now, only talking about these two items, when you think what are the consequences of these 2 points, I think, again, the basic difference to me is that until now, when the Polish taxpayer provided the documentation to the tax authorities, it was for the tax authorities it was necessary to prove that a given transaction is concluded on non-market conditions. So it was necessary for the tax authorities to prove that the given transaction is not in line with the arm's length principle. Now it's opposite. What you see here is that by providing the financial data and the profitability on specific transactions and comparing this data with the results of the benchmarking studies that you need to prepare will mean that you effectively need to prove that you earned a market return on your transactions. So the burden of proof is on you and not on the tax authorities' side. And to me, this is the biggest shift when you think about the local file. There are also a few other items which are also required under new regulations, but I think I would like to turn your attention to restructuring. Now, the new rules oblige the taxpayer to explain in the documentation whether any restructuring has taken place in a given year or in the prior year. And by restructuring, you probably know what is meant. It's basically meant a transfer of economically relevant risks, functions, or assets, or a termination or renegotiation of relevant agreements. Now, I mean, it's not the only place where you will need to describe any restructuring that has taken place. I will mention later also that in a CIT TT form, you will also need to disclose such information. So this means also that you need to be consistent in a way you present different information in different forms and documentation packages. Now, I think that one additional point I would like to mention here is that the taxpayer will also need to explain why they have chosen a given method. Until now, the taxpayer only had to explain what method it applies in a given transaction. It did not have to prove that this is the best method. It had only to explain how he calculates a price in a given transaction, and that's it. There was no need to test. There was no need to prove that this is the best method. Now, again, we have to prove that this is the best method, why we believe this is the best method. So this is additional burden on our side. And that's I think the essence when you think about the local file. Now, if we move to the next item that Piotr already mentioned, we talk here about the taxpayer statement. Taxpayer will need to confirm and sign this statement that they have prepared the documentation as required, and the documentation is complete, and they will need to submit this statement together with the annual corporate income tax return. I mean, there's maybe nothing specific around this statement. It can be fairly simple, but it means in practice that the person who signs the statement will be personally liable. And if the statement is submitted while the documentation is not in place, such a person can be liable, and the penalties under Penal Fiscal Code can include financial fines depending on the situation. If the statement is not submitted, it's 120 daily rates. Daily rate is calculated basically depends on many factors, but the daily rates is as small as 15 euro roughly, but can be as high as 5,600 euro. So depending on the status of the person who signed the statement, the fine can be very heavy. Now, what the statement also means is that the person who signs the statement should really take care of the planning of the documentation, because it will be personally liable. So need to plan ahead what and when should be done. Once the plan is in place, also should supervise the preparation of the process, so that at the end, when the documentation will need to be in place, it will have also enough time for verification of the completeness of the documentation. Because I understand that no one wants to be personally liable and pay the fines from its own pocket for not meeting the requirements. So that's the second item. And now we will move to the CIT TT form. It's a form which basically looks like a tax declaration. I will show it in a second, so you get a feeling how it looks like. But it is a form which is designed to provide to the tax authorities information which will enable them to select in a more easy way the companies for the transfer pricing audit, and that's clear. That's the purpose of this form. So when you think about this form, you really need to think, okay, what's going to be inside, what you will put inside, and whether it may mean any consequences to you or not. So apart from standard sections, this form includes sections from C to G, as you can see on the slide. Section C forces you to provide the information on the relations between the taxpayer and other companies in the group. You need to simply explain in what way you are related with different companies. And then in section D, you also need to provide information on the entities, on the number of entities with which you are related. And you need to split these entities between those which are in Poland, those which are outside of Poland within European Economic Area. And also you need to split it between those entities which are located within European Economic Area where we have an exchange of tax information and we don't have the exchange of tax information. Now, the next section, section E, is, I think, critical for, again, identification taxpayers for the audit. In this section, you need to provide two pieces of information. First of all, you need to define what type of entity you are, what kind of profile the taxpayer has, whether it's production, distribution, service company, and any other types. And you also need to explain or actually provide the information in what industry you're operating in. So, I mean, these two criteria to me are pretty critical when you think about the fact that these forms can be electronically scanned and can be used in a very efficient way to select the entities for the future tax audits, for example, devoted to any special industry or any special types of entities. The next section, section F, is the one that I already mentioned when I was talking about the local file. Here, the taxpayer need to say whether they went through the restructuring and whether they change also the form, the way they operate. And apart from this question, there is also a question whether the taxpayer paid any indemnification or received any type of a payment for being restructured. So you need to declare it and you will need to sign it. And then at the end we have section G is really the longest section, and it's really a section which is an information about the different types of transactions concluded by the taxpayer. To complete this section, you really need to spend some time because you really need to do an inventory of different transaction types you have. You need to define what types these are, and then also you need to know the numbers, the values of these transactions. And the split is between sales, production, service transaction. There is a separate section devoted to assets, and in particular intangible assets. There is a separate section on financial transactions, and there is also a requirement to provide information on the level of receivables and liabilities. So this sounds to me like an area where you need to think whether you are not providing any financing in a form of longer period in terms of payment in a given transactions. And there's also a section where you need to explain whether you concluded any cost contribution arrangements. So this is the CIT TT form, and just to show you how it looks like, I mean, you can see at the slide that there are some pages. It's not designed so you can read it. Anyway, it's in Polish, but this is just to give you a flavor how it looks like. So it's really like a normal annual tax return. It's quite comparable. So that's about local file, statement, and CIT TP form. And now we will move to the master file, and Piotr will talk about the master file.
That's right. The next element that we would like to describe for you is master file. This was item number 4 in our general overview section. So as we mentioned before, many of you are very familiar with this type of document. You have already prepared such documents for your groups. So you may not be surprised you may not be very much surprised by the contents, but there are a few very specific regulations concerning this element of the TP documentation. So yeah, just starting from number 1. The first item may be obvious. It is company overview, where we present the name and indicate which company is obliged to prepare master file. It seems to be as simple as that, but this indication of a specific company has significant consequences on the Polish market. There were some questions already I've seen on the chat that related to the deadline for preparing and submitting the master file. So in this case, it is very important what you indicate in section 1. Because, as I said just at the beginning, the deadline for preparing master file depends on the financial year and the date when a given entity is obliged to submit CIT return. So it's tax declaration. And in the case of master file, it depends on the date when the entity obliged to prepare it submits its CIT return. So yeah, maybe using an example will be easier. If all the Polish entities have financial years equal to calendar year, but the entity obliged to prepare a master file within the group is, for example, based in Belgium, and this Belgium entity has a financial year ending on 30th of June of a given year, and is required to submit its own tax declaration even after that date, obviously, then the deadline for submitting master file in Poland will also be extended in line with the deadline for submitting CIT return by this Belgium entity. So it is very important to choose carefully which entity will be preparing this master file, because you need to, for example, first of all, you need to choose an entity which will have all the information required by the Polish regulations on one hand, and on the other hand, you will need to carefully monitor its own reporting deadlines to be sure that it is prepared on time, also based on Polish regulations. So this might be a bit tricky here. Section 2, group structure. This is something that everyone would expect in the master file. You need to prepare you need to provide information on your shareholding structure, on your organizational structure, just to give an overview for the tax authorities. Point number 3 is TP policy. Not every multinational enterprise has its own TP policy, but it is a required element of the master file. So you should generally present the terms of related party transactions that are applied within the group. And the idea behind this point is of course to enable the Polish tax authorities to have a look and give them insight into general terms of cooperation between related parties within a given group, and they would like to make sure that Polish entities are applying the same rules as the group as a whole. So this is also a very important element. And if you have not prepared such TP policy beforehand, it will not be required, at least in Poland. And I expect that similar regulations will also be enacted in other countries. Point 4 is business overview. This is quite straightforward. In the master file, it is of course necessary to present the business in which a group operates. It is welcome to include a brief description of the market to show what are the key success factors, what is the situation of the market, just to give the tax authorities some knowledge about a given industry. And this section may also be of benefit for our group if we are able to explain the tax authorities that for example the market situation is difficult over the last few years, or at least we are now entering new markets, and our strategy is a result of for example changing market environment, and we present all these facts in this section. We may later on build on that when explaining our profitability. And as Sebastian mentioned previously, it will be a key element of the local TP documentation. So if we can build our base and present the market, present the industry within master file, we can then use this information in local file to substantiate our results and prove that they are arm's length. And in my opinion, point number 5 is the most difficult one and the most sensitive one. The tax authorities will require taxpayers and multinational enterprises operating in Poland to present details about their intellectual property. And it is not enough to discuss intellectual property which is, for example, licensed by the Polish subsidiary, but the tax authorities require more. It is worth mentioning now that alongside the new CIT law, also transfer pricing decrees were published, and in these decrees there is specifically mentioned that taxpayer should provide strategy towards the IP. They should disclose relevant intra-group agreements that are binding within the group that relate to not only licensing trademarks, but also how these IP rights are created, who is responsible for monitoring any infringements, who is responsible for incurring costs of developing these IP rights. These are all elements that should be included in the master file. There is also one more very specific element. It should also be described whether the legal as well as economic ownership of this IP rights was changed within a tax year. So the tax authorities will also need to have full information about this local and economic ownership. So this is something completely new on the Polish market, and this is the first time that you will be obliged to present that detailed information to the Polish tax authorities. Point number 6 is group financial statement, group financial information. In this case, as you may expect, taxpayers will be required to present consolidated financial information of a given group. So this is also something that you could expect. And number 7, agreements, APAs. So if a given group has concluded any APAs in any country, it should be also indicated in the master file, so that the Polish tax authorities are aware of any such agreements. So that's it. If in terms of master file, if you have any further questions, please ask on the chat, or maybe contact us after the webinar. And now I'd like to move to country-by-country reporting. I've seen that there were also many questions concerning this element of TP documentation. So maybe just to answer them at once, the Polish country-by-country requirements concern only Polish entities. So you see that the first requirement, only domestic entities, which are at the same time parent companies in Poland. They have subsidiaries, and it is important that they are not a subsidiary of any other capital entity. So there is no next level of in the group structure above these entities. So if you, for example, have a part of the group operating in Poland, and it is the financial data of this group are consolidated on a higher level in Europe, for example, or globally, you will not be obliged to submit country-by-country reporting form in Poland. You will perhaps be obliged in that other country where the headquarters is located, but not necessarily in Poland. This is the second condition that is presented on the slide. And the other ones are also quite, let's say, intuitive, as you could already expect that there are such conditions. So the country-by-country reporting form, the country-by-country requirements concern entities who are also preparing consolidated financial statements at the Polish level, who have foreign subsidiaries or PEs or any other units, because if we have only domestic companies, there would be no need to prepare a country-by-country reporting template. That's obvious. And as I mentioned before, there is also a materiality threshold of 750 million euro. So exactly the level which was recommended by the OECD within the BEPS project. So just to wrap up, the country-by-country reporting template in Poland relate only to domestic entities. So I guess it should answer many of the questions which were asked on the chat. And just to give you an overview again, as in the case of CIT TP return, you see now how the country-by-country reporting template looks like. It is partially in Polish, partially in English. There was also a question whether you would be obliged to submit CBCR information in Polish or in English. I think, at least in this case, it would be very simple, because you provide generally numbers, and the headings in the tables are in both languages. But as you are interested in transfer pricing matters globally, perhaps you have already seen the table required, because it is also in line with what the OECD has recommended. So that's it. If we think about 5 elements of the TP documentation, I would now also again pass to Sebastian to summarize what we have said.
Okay, so summarizing the changes, what you need to remember is that the new transfer pricing documentation requirements effectively mean an extension in terms of scope of documentation that taxpayers will have to prepare. And this is obviously a minus, and obviously we will have additional forms and requirements like CIT TT form, country-by-country reporting form, taxpayer statement, and master file, which was not required so far in Poland. And we have pretty tight deadlines. The positive aspects are an increase of the threshold up to 25% from 5% currently, when you define the entities as related in terms of capital relationships. So this is a positive change. And the second positive change is introduction of higher documentation thresholds, as Piotr outlined on the earlier slides, where you need to document the transactions only above certain threshold, especially if you have a higher revenue, if you are a big taxpayer. So that's one thing. The second thing is you need to remember that the new law introduces new tools for the tax authorities to make their life easier, to assess which entities should be selected for the transfer pricing audit, and this is especially CIT TT form and country-by-country reporting form. The third message is that preparing all these pieces of documentation require a significant amount of information, not necessarily purely from few countries. You need to gather this information from different places. And also you need to think how to present them in a consistent way. And I think that the last, probably quite critical to me, but relevant change is really a shift of burden of proof in terms of market conditions of the transactions from the tax authorities onto the taxpayers. So this is basically a summary of changes, and now you may ask yourself a question, okay, what does it mean to me? Our recommendation would be the following. I would propose that you, at least as a minimum, do a transfer pricing risk analysis. So you try at least to prepare the CBCR form and CIT TP forms as a minimum, and analyze to what extent these forms may create an exposure for you, for your group. And also, if there are any exposures, then you need to think whether any actions should be taken to mitigate these exposures. That's one thing. The second thing is, obviously, you need to think about the documentation. And here, first thing is, okay, you need to answer a few very basic questions. First question is, what should I do? So, already, which transactions I need to document, what type of forms I need to prepare. And then you need to do an inventory. So you need to answer the second question, what have you got already? Because probably you have already developed lots of information, and all you need to do is really to think what are the gaps, what is missing, and try to think, okay, how to complete and how to prepare the full package that is required from you, from your entity. Now, the next question is, who is really responsible for what? Because different pieces of information will come from different places, not necessarily from your entity. So you really need to know which forms will be prepared by who, and what pieces of information you need, and from where they will come. And then the last question is, when should I do it? So you need to aggregate all these data. And you need time to prepare it, to prepare the documentation, to verify it, and you need to think about one I think item, that preparing the full package for the first time is quite critical, because it's going to be quite easy then, if nothing really dramatic changes, to update them, because then the last actually last question, but the last, which will relate to the further years, is how often should I update it? And the documentation should be updated every year, but benchmarking studies will need to be updated at least every 3 years. So again, when you develop a good package for the first year, you will really have a good base, and it will serve you for the following years. And that's it basically from our side. Thank you very much for your attention, and if you have any other questions, please contact us directly. I hope you will find this presentation useful. Thank you.
Thank you very much. Bye-bye.